My friends, when you strip the stock market down to its core, it's really just one thing. The most expensive emotional roller coaster humanity has ever invented. Every single day, billions upon billions of dollars are thrown into it by millions of people, not because of logic, but because of feelings. I think this company is about to explode. I think this industry is the next big thing. Everyone else is clueless. I'm the smart one. And what happens in the end? When the market is booming, everybody thinks they're a genius. When it crashes, suddenly everyone becomes a long-term value investor. Usually the kind who's trapped deep underwater. Today, I'm not going to talk about candlestick charts, MACD indicators, golden crosses, or death crosses. You can find all that in textbooks. Instead, let's talk about something more painful. Why do you think you can actually make money in the stock market? Let's start with the basics. A stock, in theory, is the discounted value of a company's future cash flow. In plain English, you buy a stock because you believe the company will make more money in the future and hopefully share some of it with you. But here's the catch. Most of the time, stock prices don't move because the company itself changed. They move because people think the company is about to change. In finance, that's called expectation. And expectations change faster than summer weather. There's always a group of people in the market whose words matter more than earnings reports. A billionaire investor praises renewable energy. The entire sector surges the next day. An analyst warns that the AI bubble is about to burst. Tech stocks plunge 2 days later. It's not necessarily because they predicted correctly. It's because they influence expectations. At its core, the capital market is a giant storytelling competition. Whoever tells the most convincing story attracts the money. Take the 2021, for example. Retail investors gathered online and crushed major hedge funds that were heavily shorting the stock. That wasn't driven by company fundamentals. It was driven by a powerful story. The little guys getting revenge on Wall Street. Or look at geopolitical tensions between the United States and Iran in 2026. Global markets tremble, not because missiles are literally going to hit Wall Street, but because investors expect a chain reaction. War pushes oil prices higher. Higher oil prices fuel inflation. Inflation makes the Federal Reserve hesitant to cut interest rates. Money becomes more expensive. Stocks fall. And once even one part of that chain gets turned into a compelling narrative, the entire market starts running with it. That's why the most powerful people in the market are not always the best accountants or analysts. They're the best storytellers. Most retail investors are not really chasing companies. They're chasing a future exciting enough to keep them awake at night. Now think about this. Why does it always feel like the moment you buy, the stock drops, and the moment you sell, it rises? It's not bad luck. Human psychology is simply being manipulated with terrifying precision. Behavioral finance has a term for this. Herd mentality. When stocks rise, you panic. If I don't buy now, I'll miss out. When stocks fall, you panic even harder. Something terrible must be happening. So you follow the crowd. And before you know it, you're trapped. Then there's another classic psychological trap. Anchoring bias. You see a stock fall from $100 to $80 and think, wow, it's cheap now. So you buy. Then it drops to $60. You tell yourself, I'll sell once it gets back to $80. Then it falls to $40 and you emotionally give up. That original $100 price becomes nailed into your brain. At that point, you're no longer judging what the company is truly worth. You're arguing with your own emotions. And here's what you eventually realize. The people who consistently make money aren't emotionless. They simply know how to act against their emotions. When others are greedy, they become fearful. When others are fearful, they become greedy. You've probably heard that quote hundreds of times. Actually living by it is incredibly rare. Now, let's do some math. Because numbers don't lie. Lose 10%, and you need an 11.1% gain just to break even. Lose 20%, and you need 25%. Lose 30%, and you need 42.9%. Lose 50%, and you need 100%. Lose 80%, and you need 400%. That's the brutal asymmetry of losses. The deeper you fall, the harder it becomes to climb back out. That's why experienced investors always say, cut your losses before they destroy you. Losses compound against you. Gains don't work the same way. If you start with $100,000 and lose $50,000, you haven't just lost half. The remaining $50,000 now has to double just to get you back where you started. And doubling money is far harder than most people imagine. So here's the first rule of investing. Never lose money you can't afford to lose. Borrowing money to buy stocks, using massive leverage, betting your life savings. That's not investing. That's gambling. At least in a casino, you know the odds. In the stock market, most people don't even understand the game they're playing. So, what should ordinary people do? The answer isn't stay away from the market. The answer is, don't play blindly. The stock market really is one of the best wealth-building tools available to ordinary people. But only if you approach it correctly. First, invest only spare money. Money you can lose without affecting your rent, food, healthcare, retirement, or your family's future. Don't throw medical bills, tuition money, or wedding savings into the market. Second, don't chase hype. By the time mainstream news tells you that AI, crypto, or some future industry is the hottest thing on earth, the early players have usually already made their fortune. You're often just the exit liquidity. Real opportunities are usually discovered before everyone starts talking about them. Third, admit what you don't know. Most retail investors lose money for one simple reason. They think they understand more than they actually do. They read a few earnings reports, watch a few experts online, and suddenly believe they can predict the market. But who are they competing against? Quantitative trading firms, hedge fund managers from Wall Street, professional research teams working 12 hours a day. Why assume you have an edge? The stock market is not exactly a casino, but it feels dangerously close. The difference is, when you lose in a casino, you know the house took your money. When you lose in the stock market, you often convince yourself it was just bad luck. In the end, the thing that truly keeps you alive in the market isn't secret information or technical analysis. It's self-awareness. Knowing your limits. Knowing which risks are worth taking. Knowing when to walk away. The greatest traders are not the ones who made the most money. They're the ones who survived the longest. So let me ask you, in the famous saying 7 lose, 2 break even, 1 wins. Which one are you?